Hi, this is Yanis from Never Stop Trucking. In this video, we will be talking about factoring. Is factoring a loan, or how can you classify it, not just for business purposes, but also for bookkeeping and accounting purposes? I spoke to several people lately, and most of them have a misconception that factoring is a loan and that you're actually getting money loaned to you, and that this money is still owed to you by the broker until they pay. So, factoring, in fact, in most cases, we will have the recourse or non recourse. In most cases, the factoring company will charge you back if a broker does not pay. So they use a term buy an invoice. So they are buying that invoice from you, and you're transferring the rights to be paid to the factoring company. For example, you're doing a load with Coyote and you need to get paid. Instead of sending the invoice directly to Coyote and wait 30 days to get paid directly to you, you will sell that invoice to a factoring company. In a regular way, when you get paid directly, this money, until it's paid out completely, can be considered as your accounts receivable. This is an outstanding amount that they owe you. So until that's paid out completely, you can consider it that as your account receivable and an outstanding invoice, and you can claim it. You can say, I can count on this money. This money will be eventually paid to me. Someone owes me that money, right? But if you're sending that invoice to a factoring company and the factoring company sends it to Coyote, it works in a different way. The factoring company will deduct their fees, whatever the fee is, 1, 2, 3%, whatever it is. They will deduct it right away from that invoice. They will pay you the remaining 97%, for example, of that money, because 3% is their fee in exchange for you getting that money right away. And then they own the invoice, the payable invoice, right? This amount is only payable to them from the factoring company. At this point, you have nothing to do with that invoice anymore, except if the broker down the road does not pay, the factoring company may charge you back for that money. In fact, most likely they will charge you back for that money. But in normal circumstances, this invoice will be paid to them eventually in 2 weeks, 4 weeks, 6 weeks. It doesn't matter. But what matters is that this money is no longer yours. This invoice is no longer yours. It becomes to the factoring company because they bought it from you. And that's what they say. That's what it says in your contract. That's what it says when you check the broker. If the broker is on no buy list, that means they will not buy that invoice. Now, emphasis on that word, buy. They will not buy the invoice, purchase it from you, because that broker has a bad history of paying, or something is wrong with them, right? So you have to have that conception in your head, how it works. Some people will say this is a loan, and only once the broker pays to the factoring company that this is no longer a loan. No, it's not a loan, because in order for this to be a loan, it would have to mean that you would have to pay it back. You don't have to pay it back to anyone. If you get a loan, it means you have to eventually pay the money back. You have interest rate, you have set amount of payments or set amount of months, etc. Late payments, stuff like that, collection, everything. You know that that comes with a regular loan or a credit card or a car loan or a mortgage. This is not that. The mortgage or the loan will be paid in equal payments over a course of set amount of time, and there will be interest, and this is usually APR interest, right? They usually mortgage is different, but let's say you have a credit card. The interest rate it works different. It's not like in when you do factoring, they charge you 2 or 3% from the invoice, and they charge it right away. And this is not something that goes on for the remainder, for the life of that invoice not being paid by the broker. This is a one-time fee that they charge you right away, and you don't get charged that fee or any other fees anymore. This is a one-time charge. For example, you have an invoice of $1,000. They charge you 3%. The factoring company will deduct those $30, that 3%, and you will get $970 paid out, and that's it. No more fees, no more charges. This is not your interest. Only, like I said, if the broker does not pay, the factoring company does reserve the right to charge you back for that money because they didn't get paid. It's in the contract. That's the only difference than if you were to do a regular purchase. For example, you buy a car, you buy a TV, and you give them money and they give you the TV. That's it. This is the only exception. If they don't get paid for this invoice, they will charge you back. So this is not a loan where you have to give the money back. There is no interest fee, and you don't owe that loan back to anyone. Okay. And why am I saying this? Because people will not understand how to put these transactions through their books. If you have a bookkeeper that understands how factoring works, then they can explain it to you. But if you're doing bookkeeping by yourself and you're trying to record these transactions as a loan, it will not work because this is not a loan, right? The money you get from the factoring company, that's your revenue. That's your gross revenue that you're getting, okay? Minus their fees. And bookkeeping is same as math. You can do math in many different ways. As long as the outcome is correct, then most likely your math was okay. Maybe the process was not correct. Maybe the process was different than what someone was asking. But if you have IRS auditing you or looking at your papers, as long as the end balance checks out, you have all the receipts, everything is legal, then it doesn't really matter whether you record the factoring amounts that you're getting as a loan or as a purchase. That doesn't matter. But what matters is that you're complicating your life. You don't have to do that. There are only two transactions in this instance. But with the loan, you have multiple transactions. You have interest, you have payments. So you're just overcomplicating things for yourself. And at the end, it is not even true that this is a loan, right? Now, some people will argue that, hey, I could get a loan from a bank instead of working with a factoring company. I could get a line of credit for like $100,000 or so, and then I can use that for my cash flow until I get paid by the broker. And that's fine. That's an option. But all of these have different up and down sides. With factoring company, you don't pay interest. With a loan, with a regular loan, you will pay interest. You will have payments. You will have to pay that money back to them that you borrowed. So there will be interest at the end. You will be paying more unless you make those payments right away. But then you don't need a credit. if you're going to be making the full payment every month, right? But on the other side, if you have a factoring company, they will put a lien on your company, and they will have a saying, some saying in your finances, right? You can't really do everything you want if the brokers still owe them money for those invoices that they bought from you. So there are up and downsides for each one. In my opinion, line of credit doesn't make sense if you're gonna do it in long term. If you're gonna do it for like a few months or a year or so, then maybe. But with factoring, it's a one-time fee, one-time charge, and down the road when you get some cash, when you make some money, then you can even ditch the factoring. I work with RTS. Check their link in the description of this video. They have been in business for decades, and they will take care of you. If you use the link in the description, they will give you discounts or current promotions based on that. Thanks for watching. This is Anis from Never Stop Trucking and your Express.